This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, shocking new reports reveal that the U.S. economy is in far worse shape than the White House claims. And we don't have just one report, but three separate government reports that, based on the data we're looking at right now, suggest by the time the November elections get here that the U.S. economy will be in the midst of a deep and protracted recession. So now let's head over to the Philly Fed, and I want you to be the judge here. Do you think we're experiencing a soft landing, or do you think, based on the data I'm about to show you, that the economy is about to head off a cliff? And with that, now let's look at the Philly Fed as we see their large bank credit card and mortgage data report giving us some insights looking back over the last quarter as we look to credit card real balances and utilization is now approaching pre-pandemic figures. Now, based on the headline alone, we might suggest that, hey, credit markets are actually good, because when consumers believe that their future is looking optimistic, that they're going to see wage gains and prosperity, they tend to buy things today knowing that they'll have the resources to pay them later. Now, the other side here is if consumers have fallen behind inflation and they're trying to keep their heads above water, they will often turn to credit cards. So the question here is, are we seeing in the credit card data optimism, or are we seeing consumers getting swallowed up by inflation as nominal credit card balances, which surpassed series highs for the 50th, 75th, and 90th percentiles in the third quarter of 2023, continue to grow in the fourth quarter of last year? Nominal account balances, that means not inflation adjusted, however, have increased in the fourth quarter every year, which makes sense due to the holiday seasonal factors. But when adjusted using the U.S. Consumer Price Index, real or inflation-adjusted account balances remain below the percentile levels reported in the fourth quarter of 2019. In fact, real account balances are quickly approaching pre-pandemic heights, though, with the median real account balance increasing 5.4% year over year. So what we're seeing here is consumers taking on more and more debt. The question remains, is this a positive sign that we're indeed experiencing a soft landing, or does this start to suggest that the economy is looking over the edge of a cliff? Well, as we look at performance, we see it worsen to historical levels, suggesting the consumers aren't confident at all. In fact, what is starting to suggest here is that consumers are falling behind due to inflation, as credit card performance further deteriorated at the end of last year, with firms recording the worst 30, 60, and 90-day account-based days past due, meaning people are late on their payments in the reporting series. Notably, card performance usually declines in the fourth quarter, again due to holiday spending. Stress among cardholders was further underscored in payment behavior, as the share of accounts making minimum payments rose 34 basis points to a series high from last quarter's reading. To here, it makes perfect sense that consumers aren't optimistic about the future at all. In fact, they're struggling with inflation. And we note that because we can look at this data series here where we see the Consumer Price Index shown in blue against average hourly earnings of production and non-supervisor employees multiplied by average weekly hours of production and non-supervisor employees to get what we call total compensation. And what the government's going to show here is, look, you're getting ahead of inflation. Your wages, your compensation is greater than what the Consumer Price Index is. So what's the problem? You should be seeing prosperity here. The challenge is, for 2 years, American households fell behind and they took on more and more debt. But we've got some other reports that are going to really open some eyes here. And what's going on underneath the U.S. economy would suggest that even though total compensation, as we see here, is above the Consumer Price Index, what is not showing is the debt burden that American households are under. And new mortgages exhibit riskier characteristics as affordability issues persist. And again, this isn't something that you would hear in a booming economy or in a soft landing. What you might hear is that new mortgages are being issued as consumers look to be able to easily afford houses and believe that they're going to have no problem making their payment. Now, we're not seeing that kind of a headline at all, as originations declined to a series low in the fourth quarter of last year, as as market headwinds continue to stifle overall mortgage demand. And year-end data highlighted shifts in large bank underwriting practices, as we've noted, largely relating to rising household costs. So banks are saying, look, your costs are going up as a household, and we're not sure you could afford this. And so it all starts to put into path where the economy is headed. Of course, that's not good news for the U.S. economy to begin with, but particularly bad news for the incumbent president if he faces a recession around November. Well, all odds of getting reelected pretty much go to zero. And this indication coincides with the Atlanta Fed's report that home affordability has drastically worsened since the end of 2021. And what we want to hear is that things have gotten better. But while mortgages are getting riskier, one thing that should be getting de-riskier, should be easier for you, is trading and making money in the markets. We show you how, because let me show you a trade. This came back from last year, and you think, can it be this easy to make money? And the answer is yes. And how do we do it with such less risk compared to everything else? Well, simple. We have two reports. One is our CTA report. Look at this. Agricultural commodities. Who would have thought? Now that trade up 16.77% on our CTA report. I'll tell you about that in a moment. If you would just put $5,000 on that, you would have paid for your report more than 2 times over for the year. How about our tactical analysis report that looks at momentum? It's up 21.23% as it picked up the trade 4 days later. That one, you'd be up almost 5 times on your initial investment for a year. Here you can see, of course, the data. But what's the difference is we teach you how to trade with the machines. You know, everyone trades against them. We show you how to get in before them because we run a historical overlay on machine positioning. We tell you when they're extremes, and then we give you the signals. How do we do that? We have a report that comes out every day except holidays and Sundays, and we put out a video. Our subscribers love this because we show them the trade setup, give them the stop loss levels, encourage them on how to look at the trades. And then what if you're a technical trader? What if you like those things like the RSI and the MACD, but you find yourself getting in the market late and out early? Well, we take across multiple signals and we smooth them out with a proprietary overlay to de-risk your trading. We put you ahead. When momentum signals shift, we give it to you before anyone else. Again, reports, videos, we're helping you make money, and we do it with a 30-day free trial. You know, my friends, only 7. Check out the links below because existing home sales now plunge. We talk about affordability dropping. Well, look at this. We talked about new home sales. What happened? In the show the other day, we said they dropped over 14%. But what was the big data underneath that about the housing market is that builders were sitting on as much inventory as they were back in 2008. Of course, we know that meant prices came crumbling down. And now look, existing home sales again plunge as prices continue to rise. That's not going to last for long, but after the collapse in housing starts and permits in March, which we covered on the show the other day, it's no surprise that existing home sales disappointed in the same month, dropping 4.3%. The biggest drop now since November of 2022, with sales down almost 10% from a year earlier. That is staggering. And here you can see, of course, new versus existing home sales. New home sales are coming down, existing home sales are rising, and that means is that builders are going to start competing with existing home sellers. And guess who's got a whole lot more margin? Well, that's the builders, and they will start cutting prices, which will put downward pressure on existing home sales. Now, what's dangerous here is this footnote by Zero Hedge, as they note the first-time home buyers made up 32% of purchases in March, up 26% from a month earlier. So what we're seeing is first-time home buyers coming into the market at very high prices, at very high rates, under maybe the idea that they can refi as they go down. Of course, what they don't realize, if prices come down, they're going to be trapped in those homes with no equity to refi because they're going to be upside down. Meanwhile, their boomer parents are going to be stuck in their homes as ultra low rates because they don't want to move. And so next thing you know, you're going to have 2 big economic cohorts stuck in their homes. Not a good thing for the housing market, but what we can see is prices indeed coming down. But what was the big report here? So we see now credit card delinquency rates going up. Not a good sign for the economy, not a good sign of where we're headed toward the elections. But what is the real reveal here is the beige book. And then another Fed report reveals the economy is in far worse shape than the White House claims. This headline from Zero Hedge, And there was something odd about the latest beige book, which is, if it's accurate, would suggest that the rosy economic picture painted by the White House and the Fed and all the other political elites is woefully incorrect. Of course, we note that on this show on a regular basis, that the underlying economy is nowhere near as good as the headline data suggests. And here we can see that in the report, where of course spending is 70% of all economic growth, the beige book found that consumer spending barely increased overall. And what have we been talking about is the fact that consumers aren't keeping up with inflation. We've been talking about how the labor market isn't as strong and robust as everyone says, because again, if it was, what we should see is, of course, consumer spending increasing. Instead, we're not seeing big numbers there. Here we can see weakness in discretionary spending as consumers' price sensitivity remained elevated. And we've talked about this on the show here recently about higher energy prices. Now, this report came out before energy prices really took off, but how that would eat into discretionary spending. So you can imagine future reports from the beige book are going to say discretionary spending likely went down even more due to higher energy costs. This is dangerous. And here we can see sales remain sluggish for auto buying. If you're looking to buy a car, maybe hang tight a little bit. Prices may come down some more, but there's more. Contrary to surging wages of the post-COVID era, the beige book found that multiple districts said their annual wage growth rates had recently returned to their historical averages. Now, what have we been hearing from all these political elites? That look, they're getting huge wage gains. Consumers and workers are getting ahead, but we've been saying, look, something doesn't add up here. Maybe that number is printing above the consumer price index, but the spending data doesn't validate. Something here isn't adding up. Now we're starting to see it in the beige book. I'll show you what that historical average looks like. And here we can see, on balance, contacts expected labor demand supply would remain relatively stable, with modest further job gains, continued moderation of wage growth back to pre-pandemic levels. And what does that mean? Well, that means average hourly earnings for production and non-supervisory employees is headed back to around 3.5%. Now, can you imagine if this growth rate, this red line, just plunges straight down here over the next couple of months? That is going to be dangerous news for the economy, suggesting that indeed inflation isn't going to be an issue. It's only going to be is how soon will we enter a recession, because at this point, there's absolutely no evidence that we're hitting a soft landing. But again, weigh in the comments, where do you think we're at? Are we in the midst of a soft landing? Or again, are we looking over the edge of a cliff and by November saying we're going to be in a recession and likely see a new president in office? But here we can see another widely known fact. Several districts reported sharp increases in insurance rates for both businesses and homeowners. Of course, those we also know consumers seeing car insurance rates go up. Again, where does all this eat out of? Discretionary spending. When things you have to spend money go up in price, that means things you don't have to spend money on, well, those things go away and go away very quickly. And here we can see that another comment was the firm's abilities to pass cost increases on to consumers had weakened considerably in recent months, resulting in smaller profit margins. Of course, what that means is that consumers can't afford higher prices. Again, this is a case we've been making. Everyone says inflation's going to go higher. Steve, can't you see it? Don't you understand? We're in a new cycle, a new era. Inflation is going to be high forever, unless, of course, people can't afford it. And in that case, if people can't afford it, prices actually do start to come down. And sure enough, if we start to see corporate profits erode, well, that does not look good for the labor market, because companies will defend their profit margins. And here you can see corporate profits after tax in blue shown on a year-over-year rate of change against continued unemployment claims. And you can see these contractions in profits. Well, that leads to people on the unemployment line staying there. And you can see it happens over and over and over again. And right now, we're seeing a little bit of resurgence over the last quarter. We'll see what this quarter brings. But what we do know is if demand continues to fall, corporate profits are going to roll back over and head down. More people on the unemployment line. And again, as we race ahead toward the end of the year, all this suggests, in my view, is that we're headed into a recession in the labor market that everyone says is strong and robust. Well, it's going to come unwound, because one thing we can notice, initial claims continue to be stuck at 212,000 week after week. In fact, if you want to be an expert and make a prediction, say 212 for next week, you'll probably be right on the money. That the bigger problem here is there's 1.8 million Americans that are sitting on unemployment week week after week after week, unable to get back in the job market. And the longer they sit there, the more likely their discretionary spending has to go down. And then you think, well, their insurance rates are going up. So that means their spending is going to have to go down even more. And as they spend less on the discretionary side, that means eventually profits go down. And of course, that means prices come down. And that means the labor market starts to see more people on the unemployment line. And what's baffling many experts is the fact that initial jobless claims, well, they stay right around 212,000, despite the fact that large corporations are laying off and other companies that file worker adjustment and retraining notification act or WARN notices, those have been rising. The only question is, when do these initial claims start to pick up in a meaningful way? Because what we can know is that if average hourly earnings are indeed coming down back to that baseline of around 3.5%, what that suggests is more and more people are going to stay on unemployment. And what we need is these 1.8 million people to start getting jobs. We need to see this trend roll over and head down, but in fact we're not. And we can note that typically times where you see decelerations in average hourly earnings, it's met with a rise in unemployment claims, because you think about it from an employer standpoint. They don't need to give out big raises if they fly a job and they get a long list of applicants. So that means wage growth comes down. That's not good for the economy. That we see inflation remain still a bit sticky, at least for the time being. And we can now come back to that delinquency rate on credit cards that the Philly Fed mentioned at the onset of the show against continued claims. And it starts to make sense, because households that are on unemployment and have a lot of debt, well, if you got to put a roof over your head, you got to pay to insure it, you got to put food on the table, you got to do some other things. Well, that means you start missing payments on your credit cards, which starts to validate what we're seeing in the economy, that indeed it is not as strong as the White House and the Fed and all these other political elites want us to believe. And that makes sense, because as you see continued claims sitting where they're at, that means delinquency rates continue to head higher. That means less spending and more people losing their jobs in the near-term future. Now, we started the show with the Philly Fed. Now we're back to the Philly Fed to look at their manufacturing business outlook survey, because there's something really interesting in this report that again validates everything we're saying about the labor market here coming unwound here over the next several months. Because for whatever reason, it appears the government just wants to print 212,000 initial claims every week, week after week, no matter what, which doesn't make a whole lot of sense, particularly as we look into more of these Fed reports, which is interesting. Here we look at manufacturing activity in the region continue to expand this month, according to firms responding to the April Business Outlook survey for the manufacturing sector. The indicators for general activity, new orders, and shipments rose. However, employment index remained negative, which would be somewhat perplexing, and I'll show you why. Both price indices continue to suggest price increases, and future activity indicators decline, but suggesting firms think there's going to be more growth in the future. Well, isn't that interesting that, of course, the employment part of this is starting to fall apart? But of course, the manufacturing sector is optimistic. So we see again price gain increases here on the manufacturing side that consumers can't afford. That gives us a hint of what demand issues we're going to face as firms continue to report an overall decline in employment. But if they're optimistic about the future, well, maybe they're not quite as optimistic as they say. The employment index edged down 1 point to minus 10.7. That's a contraction. It's 12th negative reading in the past 14 months. Most firms continue to report no change in employment, while share firms reporting decreases. That's 16% exceeded the share reporting increases. But get this, the average work week index fell further from minus 0.2 to minus 18.7, suggesting the firms on net are cutting hours. And remember, that's the first step, my friends, of before what happens and people hit, of course, the unemployment line. Now let's dig a little deeper, because we do note the price increases did happen here, but there isn't demand to back them, as the prices paid index jumped from 3.7 to 23 in April, the highest reading since December 2023, suggesting that we're going to see some more inflation in terms of, at least due to higher energy costs. Again, it comes back to consumers can't afford these higher prices. And that's one thing we see about the labor market here is we look at continued unemployment claims against the consumer price index, and we can see maybe why inflation is somewhat sticky here is because the labor market is plateaued on those continued claims. But if we continue to see a slowdown in the economy and close claims start to increase, well, there goes inflation. You see that happen every time, that eventually the longer people are on unemployment and the more people are on unemployment, the less demand you see in the economy. The manufacturing sector is just telling us that. But as we dig deep into the report, there's a key things here. One, the number of employees went down. Number two, the average work week fell, which is very telling, meaning wages are going to fall. Delivery times dropping, staying negative, meaning things are getting delivered faster. But look at this, unfilled orders. Well, before it was just a 1, now it's 0.8, suggesting that maybe what's happening here, which we kind of suggested, is that once all these unfilled orders get done and the work is gone, there isn't enough new orders to support the existing workforce. We're starting to see that initial signs, and based on what we're seeing right now, likely by the time we get to the November elections, not only will we be in deep into recession, but the odds are favorable based on historic trends. We'll also see someone new in the White House. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.